Welcome to the F Word and Friends, and today we're talking about offshore investing, part 2. So in the first episode, we discussed diversifying offshore, while keeping your money in the country and while it's staying in Rands. Now, today we're talking about a question that I also had, like, should I physically take my money offshore? Should I take my money out of the country? And these are mostly people that's worried about South Africa, where we are going. So it makes sense to do that, but not for everyone. So today we're discussing taking your money out of the country and doing a currency swap. We discussed the first episode, we discussed diversifying. Now we're taking the money out of the country.
Yeah, I think where we need to start is why would you do it? And I think always good to talk about the rand. And if we look at developed markets, capital normally flows to markets where inflation is lower and where interest rates are lower. So the point I want to make is, if we look at the rand versus the dollar, chances are long term that we will always depreciate. We will always depreciate. So I think that's one of the big reasons why you would take your money overseas and put it directly into another currency. Leonie, why do you think would be another reason why we would do that?
I completely agree with you. So rand hedging would be one of it. And I think sort of what goes hand in hand with rand hedging is political hedging, right? Because people get pessimistic, and we have all these articles in the news that sort of creates this fear where we just feel there's a need to get out. So those two go hand in hand. But remember, we need to focus on that why. And one of them being, there's so many more other market ideas out there. Remember, South Africa's market is very segmented. We don't have the equivalent of technology stocks in our JSE. So it's very segmented, very heavy overweight in things like resources and commodities. So it's different investing ideas. It's different economic cycles, for argument's sake. It's different currencies. So those are the type of things that you should consider. And it's purely a diversification stance that you want to do this. I understand that there's always going to be the rand hedging and the political hedging that comes with it, but rather consider it as other investment ideas.
PJ, practically, okay, because we said it's easy to diversify offshore. What's the minimums? We could talk about minimums. And you wouldn't take it over and bring it back within 5 years. So it's also a cash flow. You need to have enough cash flow here. That this is a long-term investment. You're not bringing the money back as a currency play. I'm going to take it out at 18, and now when the rand is 20, I'm going to bring it back, because there's costs involved as well.
People say they're afraid of the country. They're going to take $25,000. You're not going to live very long with $25,000, but that's another point that you can make. But for the diversification, you can invest indirectly, like we said, in Apple and all those companies. But directly, you normally can take up to 1 million rand. The minimum is normally $25,000. That makes sense to take money physically out of the country, but then it's capped up to, you can take 1 million without the tax clearance. And then you can take 10 million rand over and above per person if you get a tax clearance. So I think for most people that won't be too difficult, and that's per person. So you and your spouse can each take 11 million rand. So I think for most of our viewers, you will be fine. So they're not. It's not restricted at this stage. Again, if you're ultra high net worth, that might be difficult. But even if you're ultra high net worth, you can every year you and your spouse can take 22 million out. So that's quite at this stage. You can take a lot out. A lot of people, what's afraid, say they might change it in the future. But that's the main thing, you want to do it. And then the rand plays a part, like, when do you take it out? I think that's the biggest question actually is, I know it's going to deteriorate long term, but when do I take it out? Because the US markets might be expensive. But again, if your plan is to diversify over a long term, there's never a better time than now. If that's the plan. If you're afraid everything is going to go down, you want to take everything out, it might be different consideration.
So practically now, a client comes, 1 million, I want to take it over. Yes, we can assist them, but you use a company that does currency conversion. So then you convert it to currency, which predominantly use US dollar, but you have different currencies that you can use.
Just on
ask
that,
the currency, which currency do you use? Maybe Fliani can get in here as well, PJ, after you.
Yeah.
Why choose the dollar and not the euro?
Yeah, because they said the US dollar might be expensive. That's fine. You can put it in pound. But remember, it depends what you buy. Most of the shares that you buy is in US dollars. So it doesn't matter. You put it in pound and then you take the pound and buy US dollar shares. So it depends a lot on that.
Yes. So for instance, if we have a look at our offering, so we have an offshore unit trust, and there we accept multiple currencies: the British pound, US, euro, Japanese yen, Aussie dollar. So there's multiple currencies that we accept. But I agree with you. You need to consider what is the fund currency that you are investing in. There's also not a lot of funds that you can choose that are, for instance, in Japanese yen. The bulk of the currency or fund currencies available is usually USD or British pound. So that is the type of thing you need to consider. So we do allow multiple currencies, but it's essentially going to land up in the fund currency.
Okay, so let's get a little bit more technical. So now we swapped it into US dollar. In what's the structure that it's going to lie into? Are we buying share portfolios? Are we buying endowments? Because I don't want to have a tax surprise. And also, when I pass away, what happens with that money? Maybe if we can touch on those 2 points. What's the structure that I'm investing on that side?
One is asset classes, and there you can choose funds or share portfolios and that. But the other one is like more important, the structure, the vehicle. When you put it like locally, you have tax-free savings and retirement years, what you don't have offshore. You normally have inflexible investments or 5-year plans, endowments, or sinking funds. So that's a key consideration. And again, depending on what's the need for that. So we've got clients that there's short-term need, they normally can put it in that. But mostly, if the plan, like I said, this is a long-term investment for people living in South Africa, most of the time it makes sense to put it in the 5-year plan. And there's key benefits maybe to that.
Yeah. And I mean, if you've got kids overseas, something like that, 5-year plans, endowments, or sinking funds, the continuation of these types of structures and the implications for your estate is much better for these types of structures. And looking at not having to bring the funds back to South Africa. So with having your kids or whoever overseas, the beneficiaries of these investments, not having to bring it back to South Africa, not having to have an offshore will. These are I think quite good estate planning benefits to these types of structures. And of course, even CGT, depending on, once again, the structure, how the beneficiaries were set up. So I think, if you look at that compared to a more flexible structure or unit trust structure, there's no real estate planning benefits to those types of structures.
Let's talk tax. Mr. Taxman. Because clients are worried now, I take $1 million over and the market's run, it grows, now I've got 2 million and I want to take it out. Will SARS not know, and will they not want a portion of that? If my money is physically offshore, what does it have to do with my South African tax that I need to pay?
The structure that we are recommending is for South African citizens.
Yes.
So if you are a US citizen watching this, sorry. So this is for South African citizens, because the US, no one wants to touch US citizens, tax citizens, because they have very strict rules. So this is for South African citizens. So we're not trying to avoid tax here. We are planning for tax.
Yes.
So it will be exactly the same. Let's take Alan Gray, for example. If you put it in a local flexible investment or an offshore flexible, I'll say there's one difference, but on the local offshore flexible investment and the offshore flexible investment, you will be taxed the same. You will get certificates. You will get the IT3B and IT3C, and SARS will know about it. So that's why
you asked the citizen. That's why people want to financially immigrate, which is not. We're not going to talk about that.
This is not a platform for them. Again, we will do a separate episode on that. But this is for a local citizen. You are going to be taxed on all the assets that you have. And the endowment's also the same. Or the local one is maybe listed in South Africa, but you get taxed on the 30% income, 12% capital gains. Again, on the offshore, exactly the same. So you must know that is exactly the same. So the main difference is the gains, capital gains, is in dollar in an offshore investment, while the capital gains in the local one is in rands. So that can be a big benefit because of the rand depreciating over the long term. You can actually be taxed more on the local one because it takes into account rand depreciation. So that's very important. And another benefit of the direct offshore investment, that's mostly in roll-up funds. All that means is the growth of the units, you don't get tax on interest, it's actually on the growth of the unit trust. So you don't get tax on the interest, you get tax on capital gains. Again, that's what I will say a big benefit of moving offshore. So there's other benefits as well.
And then people also ask how much of my money or what percentage of my portfolio should I physically take offshore? Once again, that depends greatly on where you are in life, your life circumstances. Do you have kids overseas? Are you planning to immigrate one day? There's a whole list of questions. It's not an easy answer to have. So don't listen to your friend at the bar who's got 60% offshore. Maybe he's doing completely the wrong thing with his money. So that's why consultation definitely is worth it.
I think why it's just important, those people talking about abroad, they take offshore platform and just put it all the money, is there's a lot of other considerations. Like I said, they don't think about estate planning. They're not thinking about citus tax. And a lot of people that had money a few years ago did offshore share portfolios, but now it's a big problem to move it into a structure like a sinking fund. Most people now go into that structure because now they had a lot of growth because the markets did quite well, but now they have a lot of tax consideration in estate planning.
And remember, there's many jurisdictions, and the rules are not the same for everyone. Nothing gets handled the same way. We know of a situation where a lady inherited an amount of money that's in the UK, and she's not able to receive the money unless she goes there physically. Now, the amount of capital that's in that investment that was left to her by her husband is almost the same as the ticket to travel to the UK. So that's obviously not the correct way to structure these kind of investments, and that's why you definitely need planning and the correct advice.
It's a quick one. Lastly, to wrap it up, do I need an offshore will then for my offshore money?
That's why you that's why you do platforms like this for a South African citizen. This is the best and easiest way legally to invest money. Again, if you are a dual tax citizen, it gets quite tricky.
It gets complex. So I think sort of to summarize it, again, using a platform, because key considerations, accessibility. So yes, endowment, great, because you have that transfer of wealth that's creating that ease of use, but usually the minimums are higher versus the flex, minimums are smaller. It's more accessible for the everyday investor to start that investment. So you don't need an offshore will for offshore investment. Obviously, for the endowment, it's not necessary because you nominate a beneficiary. So it's that continuity that happens. But for a flexible investment, you either have an offshore will or a local will. Remember, platforms are going to react on the instruction from the local executor. And there's also no need to repatriate those funds. That is also important because I think a lot of people avoid using a flex because they think they'll need to repatriate those funds in the instance of someone passing away. Because there's an executor, the units can just be transferred to the spouse. So
I think what's very important there, it depends on the platform as well. So not all platforms do it exactly the same way as Alan Gray. So there are platforms where there is a repatriation of funds, even on flexible investments. So it depends on the structuring of the structure that's done actually by the platform as well. So it's not across the board, but once again, that's why it's important to get the advice.
It depends on the executive as well.
Yeah, thank you. And I must say the platforms these days are so nice. You can see your SA portfolio and then you can see your physically offshore money as well in dollars. So they made it very nice and visible for the clients and for us to manage as well to invest globally. Guys, thank you very much. Thank you, Liani. And if you have any questions, please let us know and we will answer them. Thank you very much.